Okay, everybody, thank you very much for joining this session today. This topic is startup fundraising, and we're going to be talking about the SAFE as well as how it compares to the Series First Preferred Stock fundraising instrument. My name is Sam Wong. I'm with Fundable Startups, and I am joined by Brian Dirkmatt, the creator of Series First Preferred Stock. Uh, what we really wanted to be able to do here is have people understand the concepts here. And conceptually, I invited Brian to be able to do this because I don't know if you've ever gone to a restaurant and when it came time to pay the bill, you didn't pay attention, and because of the size of your party, you they added a service fee, an automatic tip on top of the bill, but then you didn't notice, and you added another tip on top of that. Okay. That's kind of what happens sometimes when you do the safe. A lot of startup founders do not understand that they're actually paying extra in many ways. And that's just one financial mechanism that we need to be able to understand so that if you do go into using a safe, you are fully informed so that you know exactly what you're doing and how it's going to affect you, your dilution, your taxation, and all those things. So oftentimes people use a safe, but unfortunately, it's a little humorous here, but people get trapped by what they don't know and what they don't understand. And this is what we're really trying to do is shine a light on some of these issues. This session between ourselves, Fundable Startups, and Brian at Ramon Law is not a introductory topic. It is an advanced topic. We are happy to get into some additional detail. We'll do our best to be able to keep this at a high level to ensure that as many people can follow along. Okay. So let me go ahead and give Brian an opportunity. Please introduce yourself to the crowd.
Hi, thank you, Sam Wong or Sam. It's a pleasure to speak to the group today with Sam and Fundable Startups. This is an interesting topic. Again, my name is Brian Dirkmont. I'm a partner at Ramon Law. Ramon is a large global law firm with offices in multiple countries. I've been practicing law for, I think, 23 years, and my entire career has focused on startup emerging growth companies from formation to exit. I happen to focus a lot of my time on early stage financing. I also do new company formations, I do M&A and other startup related corporate transactions, but I do spend a lot of time on early stage financing. I represent both investors and founders seeking investment. And of course, I've worked a lot with the SAFE as it has evolved over the years, and I've worked before the SAFE with, the convertible note and other things, and seen the whole arc and trajectory of how early stage financing has progressed my entire career. Um, I created the series first to offer an alternative, and we'll get into that later. But again, I'm thrilled to be on this webinar, and it's interesting to do an online webinar because you can actually see, I can't actually see how many people. It's pretty intimidating to stand in front of a room of 100 people, but I only see 3 or 4 people on my screen, so it makes it far less intimidating.
All right. Well, we're happy to have you. Just to provide some context, Brian and I first met. He was the corporate counsel for one of the startups I was an advisor at. That startup ended up getting acquired. Brian did a fantastic job. He was efficient, didn't bill us through the nose, okay? But we still got the job done. So,
And
but
Sam, we met, that was almost 10 years ago or more, right? 15 years
it
ago. I
wasn't
don't
quite
know.
that long ago.
Okay.
Maybe
It was
seven, 6 or 7.
No,
Okay.
you're misremembering. It was more than that.
Okay, got it. But we had I've stayed in touch with Brian, and when I saw that Brian had put together this series first, I thought it'd be a great opportunity to be able to communicate this to our founder audience. As we're going along here, we do ask that if you have a question, please put it into the chat window. We Brian's asked that we hold questions to the end because um, this topic can be very, very detailed. All right. So please do use the chat window to be able to post any questions. So by way of background, if you don't know me, I'm Sam Wong. I am a startup fractional founder and investor. I have the pleasure and the pain of having done five startups. The first two startups shut down. The last three startups did get acquired. And I also was an advisor for two other startups that got acquired. It was startup number six there, Vinti, where Brian helped us. And that got acquired several years back. Okay. So startup number one raised the most funds, but still shut down. Startup number two had the best tech. And I was a VP of engineering three times and a CTO once. So I have some background in tech, software engineering. Startup number two definitely had the best technology, hands down. But because of execution problems, and various other issues, that company did not succeed. I focus now on helping companies, helping founders become fundable, raise funds, scale, and exit. Okay. And we have a whole library of resources. I apologize because sometimes people have said that, man, it's like working with fundable startups is like going to get dinner at the Cheesecake Factory. The menu is just too big. Well, we give you lots of options. Okay. So we do lots of pitch deck work, fundraising work. We also have a lot of lean startup services, specifically around idea validation, which is a core tenet of lean startup. So in this session, we are going to do introductions, which we just finished. Then we'll talk about early stage fundraising options. This is about these two topics. Number two and number three are about the only introductory topics. Then Brian will touch bases on some of the history of startup fundraising, safes, how common they are, but how they are problematic. We'll have some perspectives from seasoned VCs. Brian will then talk through uh, specifically the series first structure that he's created. And then we can talk a little bit about trends and impact and why this is important. And we'll wrap up with kind of an open discussion. So it'll start off as a presentation. And then we want to morph into a back and forth discussion because I'm still learning from Brian about how he's put everything together. And I would love to be able to pick his brain alongside everybody here. Okay. So to dive into a little bit of the baseline about how fundraising works, it's important to understand that there are two types of stock fundamentally in a startup or in most companies. Okay, you have common stock and you have preferred stock. Common stock is nothing special in that it doesn't give you any special rights and privileges. Preferred stock is different in that it has lots of rights and privileges to people who hold that preferred stock. It's usually held by investors, okay, where common stock is typically held by founders and employees. And there's a difference in price per share. Common stock usually has a low price per share, and because of the extra privileges, investors have a higher price per share. They typically pay a higher price per share, and that's a benefit to you as a founder because that's where you're going to be primarily doing your fundraise. Fundamentally, if we look at the two types of equity, again, common stock is not used for startup fundraising typically. Okay, I generally don't recommend it because there's some structural and taxation problems if you try to raise with common stock. Preferred stock is typically what's used. Okay, well, the challenge here is always been that uh, how do start how do investors get access to the preferred stock? There are some challenges with just selling it right away. So another way to raise funds historically is just a loan. Okay, it's got a loan amount and interest rate when it might be due to be paid back and stuff. The problem there with trying to do fundraising through straight simple loans is that most investors cannot see any return on investment for money that's loaned. Okay. So if that's the case, then there's very little incentive for them to do the loan. What investors really want is the preferred stock, the lower right hand corner there. So there was a change to a basic loan, in addition, structural change, where it allowed the loan to convert into stock at some point in the future. So what you have starts off as ugly, turns into something you really want, which is the preferred stock, and that's the definition of a convertible note. Okay. When the conversion happens, the investment amount plus interest is treated as if it was raised at the time the preferred stock was sold. There may be a discount, a valuation cap, and other financial incentives for investors to be able to, do the investment on when the company is still fairly high risk. Well, there's a problem here. What if the company cannot pay back the loan before the loan converts into stock? Well, in that case, you run the risk of the holder of the loan foreclosing on the loan. And what that really means is that the lender has undue influence and undue power or leverage over the startup and the founders. So that's not something that most founders want. So what if we just remove the requirement to repay the loan? Okay. Well, removing the requirement to repay the loan is how Y Combinator came up with the concept of a safe. It still has the investment amount but it doesn't have any interest. It doesn't have a maturity date. Conceptually, it's very, very similar. Okay. So the safe will also convert into preferred stock when there's a qualified financing that happens in the future. Okay. So the most common fundraising instruments today are convertible notes, safes, and then when you get far enough down the road, you might actually sell directly preferred stock. So if you look at this environment, it's important to understand that for the two parties in an investment, the startup and the investor, each have your own goals. The founder typically wants to minimize their dilution, they should want to see how much dilution they're going to get, and hopefully keep the cap table simple and straightforward because cap table administration and management is usually what most founders neglect, and even if they use a cap table management product and they have their attorney do it, what I've seen lots of founders do is that they don't communicate to the attorney when they want to issue equity and stuff like that. They just, do so. And then the cap table, if it's managed by the attorney and they don't know about it, then the attorney doesn't know to update it. Okay. So then the cap table software is actually out of date. So lots of challenges with that. The investor wants to maximize their ownership, minimize the risk, and optimize for taxation. Okay, and that's a big deal because investors, if they are successful, will have a very significant capital gain. And capital gains taxes 15 to 20% depending on your income. Um, if you can minimize your tax, then you could potentially have a much bigger take-home pay. Okay. There are a number of shared goals between founders and investors. You want to reduce delays on the fundraising. You want to be able to minimize your legal fees, maximize certainty, and that's always a one thing that's important. A seasoned business executive and most attorneys want to be more certain about what they're doing. And this is something that many founders neglect because they haven't been down this path often enough to understand the importance of certainty. Then, of course, both founder and investor want to build and grow the startup. There are other goals that can be variants of these or derivatives of these goals, but fundamentally, this is kind of where things are at. And it's with this in mind, I'm going to hand the ball over to Brian. I'm going to stop sharing. Brian, if you could take over the share and start going through your slides, then
All right, let's make sure I get
dive in.
this right.
Mhm.
Can you see my slide? Oh, sorry, I didn't press share yet. Should be able to see my slide now. Can you see that?
Yep, you advanced the slide, so we can
There we
see.
go. That's the title slide. All right, cool. Thank you. I intend, like Sam said, I intend to go through these a little bit quickly, and we're going to brush over a lot of deeper details, but I just wanted to lay a general groundwork and kind of a historical framework to how we got to where we are today. Hopefully that will inform and provide some good background, and then we're hoping for some good Q&A time. And that's where the real fun is. It's no fun actually just lecturing. Answering Q&A is where the real fun is. So I hope to get to that as soon as possible. So Sam already laid some good groundwork. This slide repeats some of what Sam said. The main idea is on the bottom right. When investors invest in a startup company, they want to buy preferred stock, like Sam described. So the question is, what is the best way for an investor to receive preferred stock? I started my career as an attorney in January of 2002. At that time, there was only one choice. It was Series A preferred stock. As you can see from the graphic, it's not a simple deal. That deal has been around for decades, developed by VCs over many decades, starting in the 50s, 60s. It's 150 plus pages. It's built for any size deal, really. And legal fees in today's, if you do a Series A today, 50K legal fees is the average on each side. And Sam made a good point yesterday when we were chatting to remind that the startups usually pay the investors legal fees. So when it's 50K each side, it's usually 100K average that the startup is paying to get a Series A deal done. So these deals are too complicated and too expensive for most of the early stage deals. Um, so the investor community needed a solution. They needed something more simple. They needed a way to get investor money in quickly, and eventually get preferred stock. So as Sam described, the convertible note was the solution at the time. It may be interesting to everyone on the call to learn that convertible notes they were used historically as bridge notes to bridge between like a Series A round and a Series B round. They were never used for early initial funding. So when they were used as bridge notes, it was usually existing investors who would bring in more money to sustain the company until its next preferred stock round, like a Series B round. And because they're such large deals and so complicated, they take a long time to negotiate. And so the company may need some emergency cash to tide them over for 6, 8 months or whatever. And because it was existing investors, the terms of the bridge note were not complex. The agreement was typically 15 pages or less. It contained minimal reps and warranties, very simple terms because the investors were already in the company in the Series A. And so when the community was looking for an alternative to early stage financing to the Series A, they thought, let's take the bridge note down and let's use it as initial money. And that's what became the convertible note. And that was in 2004, roughly. Um, so again, it's a simple agreement, simple terms. You may be familiar with convertible notes. They have what are called valuation caps today. Again, we can discuss that in Q&A more. But it's interesting to know that when they were first used as this simple solution, there were no valuation caps. It had not occurred to the community yet to put those in. That came later. They had discounts. Sometimes they would do warrants or other kickers, but no valuation cap. And when they were first used, there were also no more than 1 year maturity dates. Today, they're longer. Um, but remember, this is not issuing preferred stock, and investors want preferred stock. This converts later into preferred stock. It's just an easy way to get money in and then later convert. So I've already hinted that over time, convertible notes start becoming more complex. Sophisticated investors realized that they were getting a bad deal with the discount only, and they added a valuation cap concept to protect them. The maturity dates got extended 2 to 3 years. Investors and founders, usually investors, would negotiate for more rights. They'd ask for a board seat, information rights, things that are typically in the Series A deal and not in the convertible note deal. So convertible notes become more complex over time, and legal fees to do convertible note deals are getting higher and higher. So the community wants another alternative. And Sam described beautifully that even if there is a maturity date, if the company is not successful in raising a Series A and converting the convertible note before the maturity date, there's a really terrible problem because investors have the right to foreclose on the convertible note at maturity. So they have superior power and they can demand concessions from the company. They usually won't foreclose, but they will demand sometimes extra favorable terms and other things. So the reality is investors never really foreclosed and they became terrible points of contention. And also, as Sam described, investors are not investing in startups to get a return of an interest rate only like 6 or 8%, which is usually on these convertible notes. So, uh, I got ahead of myself a little bit. I was teeing up to the safe just now. Um, but before I get to the safe, I should add a footnote here with this slide. In the years 2008 and then finally released in 2010, an attorney named Ted Wang created an alternative to the Series A called Series Seed preferred stock. It's a simplified form of Series A. If you recall that slide on Series A, it's 150 pages plus of documents. Um, Here, the purchase agreement is only 15 pages. There is also a certificate of incorporation that's about 15, 20 pages, but it's certainly a whole lot less than 150 pages. Those documents are still available. I included a link here. Um, it's important to note, we'll talk later about IRS Code 1202. IRS Code 1202 was not that important back in 2010. It only became important around 2016, 2017 when the law was changed. So there was not a huge incentive to go for a moderately revised Series A financing when you could do a convertible note that was still a whole lot simpler than Series C preferred stock. So it gained little traction. I'm actually a big fan of the Series Seed documents, and I've tried to promote them a lot, but they're just are not as simple as a convertible note or a safe. So that didn't go super far. So most people were still doing convertible notes. They were getting too complex. Y Combinator created the concept of the safe in 2013, late 2013. So really early 2014 is when the public first became aware of the safe. Um, the safe is simply a convertible note, but you take out the maturity date and you take out the interest because they reasoned that those things are not, the interest is not important, and the maturity dates create undue complexity that in reality we can do away with. They created a simple 6-page document. So investors can now take the template from the Y Combinator website, review a 6-page document. The intent is not to modify the terms of the safe, that it's a templated deal. It's intended to be as easy and as simple and quick and as low in legal fees as humanly possible. And I think they accomplished that goal. One of the beauties of the safe is all of the main terms are on the first page, namely just the fact that you're putting in a certain dollar amount and that there is a certain discount or a certain valuation cap. That's really all the main terms that matter. And then there's quote boilerplate. That stuff matters, and that's actually where all the complexity is. But nobody really reads that stuff. That's what takes up the rest of the 5 pages. Um, but remember, like a convertible note, the safe converts later into preferred stock. And remember, the whole goal here is for investors to get preferred stock. They don't want a note or a safe. So the longer they sit in a note or a safe, the more frustrating it is. Um, Here's the first page of the safe. So you can see the blank line at the top where you fill in the amount invested, and then you can fill in the discount rate. I pulled up one of the earliest versions of a safe, which was discount only. The safe that is used today most commonly is a cap valuation cap only. So instead of that line where it says discount rate, it would say the valuation cap. That's really the main. There's other differences in the terms, but this is basically how the safe looks, and 6 pages long. Very simple agreement. It became very successful. Um, Over time, it took a while to catch on outside of the circle of Y Combinator in Silicon Valley. It gained traction in Silicon Valley much more quickly than elsewhere. It took more time outside of Silicon Valley, especially in the boom years of 21, 22. The safes became very popular. And you fast forward to today, Carta's State of Precede that was just released reports that a big majority of safes are used for rounds even up to 4 million. And I've done rounds 10 million plus. I've seen rounds very high using safes. And then founders will stack rounds and safes. They'll do one round maybe of 1 million or two, and then they'll do another round 6 months or a year later, 1 million. So safes are used virtually everywhere now. Um, and for deals far higher than 4 million. And I don't think the safe was originally intended for bigger deals or for this much usage. In fact, when you read the safe user guide, it doesn't say it outright, but the intent is you do one round of a safe and then you do a Series A rather quickly. But the reality is that often doesn't happen. Um, so it's become so ubiquitous because of its positive aspects. It's so simple, easy, quick. Many founders often do safe financings without even engaging an attorney, which is not recommended. But so in their minds, the legal fees for a safe can be zero. But even if you do use an attorney, legal fees are still rather low. That's why it's so attractive. But what the overlying simplicity and quickness and easiness is a lot like junk food because underneath it all, there's real complexity. The safe itself claims that it is treated as stock for IRS code purposes, and it names several IRS codes for which it claims to be treated as stock. And one of those is IRS code 1202. I won't go into details, but just real quick, 1202 says to taxpayers that if they hold stock in a C corporation for at least 5 years, and they meet a few other requirements that are usually met for startups, when they sell that stock after 5 years, the gain on that sale is tax-free on the federal level. Some states still tax, some don't, but on the federal level, it's tax-free up to a cap of 10 million, and then it just got amended. The cap is 15 million now, or 10x the basis in the stock. It's a gigantic tax break for investors. Uh, Imagine getting $15 million of gain entirely tax-free. Um, if you pay long-term capital gains at 20%, 20% of 10 mil, or, well, easy math, 10 million is 2 million you would pay in tax. So if your gain is 10 million, you save 2 million in tax. It's incredible. So the SAFE claims that it benefits, it qualifies for this. But again, remember, the SAFE converts into stock in the future. It has equity-like features, but it is not actually equity. And so there is still dispute and uncertainty as to whether that claim will hold up. And there has been no IRS official comment or ruling on that. And many practitioners caution against relying on that. So you may be able to claim it. And if you are an investor, you could claim it. You run the risk of being audited. So there's uncertainty on IRS code 1202. Second is with any convertible instrument like a convertible note or a safe, you never actually know how much stock everyone's going to own until it actually converts. And I'll get into more details there. Third, zombie safes. That's a term, a slang term referring to a company that never really goes on to a Series A financing that converts the safe. And so an investor can languish for years holding a safe and has very little rights as a safe investor. Finally, there's a concept in Series A preferred stock called anti-dilution protection. Uh, this can get really detailed, but I'll just be very brief and say that anti-dilution protection under Series A preferred stock will adjust the price at which Series A preferred stock can convert in the future into common stock. And usually it's what's called broad-based weighted average anti-dilution, and it takes into account multiple factors to adjust the ratio slightly. Full ratchet anti-dilution will adjust the ratio 1-to-1. So if a company raises a Series A preferred stock financing at $10 a share today, but in the future at $5 a share, it will ratchet down the conversion ratio of the $10 back down to $5. So what a lot of people don't talk about is the safe has features that are very similar to full ratchet anti-dilution. And it's very poisonous to both the company, founders, and even to investors. So these are all complexities of the safe that aren't talked about enough and that really hurt both founders and investors. And then a lot of people say, well, we don't want to do a priced round because we're too young and we can't do a valuation yet. Well, most safes use valuation caps. And when you set a valuation cap, I agree that it's not a full priced round and it's not a full valuation, but it's getting very close. So you are essentially doing a priced round when you set a valuation cap. And I know the arguments against what I just said, but you're getting very close. So lots of dangers with the safe, but what do we do? It's a great instrument. It's so easy and quick. The legal fees are so low. What do we do if we don't want to do the
Hey,
safe?
hey, Brian.
Yeah.
Before you move on, I want to call your everybody's attention to this slide. Make sure you understand the four big bullets here because those are four big reasons why the safe has problems. Okay? And most people who've never gone down this path do not appreciate how hard this is. It's kind of like saying, "Oh, I'm just going to renovate my house." If you've never done it before, you don't realize like, "Oh, you got to
Yeah.
move out." The contractors don't do exactly what they say they're going to do. It takes much longer. It costs you more, etc. So make sure you understand that these are four major problems. And when we get into the interactive, I can give a little bit more background about how this has played out in the real world and several situations I've seen or been involved in.
Yeah, thank you, Sam. Yeah, we can't put enough emphasis on these things. And again, they're not talked about enough. Um, so there's a well-known investor named Fred Wilson. He's the founder of a VC firm called Union Square Ventures. He wrote a blog post in 2019 um, where he really does not like convertible notes or safes. And he says just do price equity rounds instead of notes. And the whole post is referring to notes and safes. So that's why I added in brackets safes. He says, I wish the whole scourge of this stuff would go away and we can go back to the way the things were done in the first 20 years. Well, in 2019, if you did that, the only option was Series A or Series Seed, and the average legal fees on one side is 25K for a Series Seed or 50K for Series A, and then if the founders are paying the investors legal fees, then it doubles. So to move away from safes or notes in 2019, it was still quite expensive. He writes further about how damaging notes and safes are, and I can't go into all the details, but he has some pretty strong language here. Basically, he says safes are a shit show, not in the best interest of founders. They defer the issue of valuation and, more importantly, dilution. They obfuscate the amount of dilution the founder is taking. They build up like a house of cards, they come crashing down. And then later, when investors like him come along and do the Series A, the attorneys and the investors at that time, they see the nightmare unfold and the whole mess comes crashing down and nobody owns nearly what they thought they would have. As an attorney, I see this a lot. But founders who are doing their first startup in their life, they read on the internet, they talk to people, everyone says do a safe. They don't know the dangers that are lurking below and this whole nightmare that Fred Wilson talks about. That is welcoming them the more safes they do. The more safes they do, the more this danger compounds. So what's the solution? What if there were a better alternative? Um, The alternative would be issue preferred stock, do away with the convertible mess. You get rid of all of those nightmares that Fred Wilson just talked about. You eliminate this entire page of problems if you just issue preferred stock right away. The problem is it's expensive. So how do you make it simpler? Well, let's make preferred stock really simple, just like a safe. Let's make the purchase agreement only 6 pages. Um, the Series Seed gets close to that, but it's still twice as long. And if you do that, what do you get? Uh, you get IRS code 1202 certainty. You hold stock. There is no question because it doesn't convert into stock in the future. You hold stock right now. No question. You get cap table clarity. There's no future conversion. You don't have zombie safe problems and you don't have the full ratchet anti-dilution problem. It's not really rocket science, but the solution that I've created is the series first preferred stock. It's just a simplified form of preferred stock that gets as close to the safe in rights for investors as the safe does. So you're stripping out a lot of stuff. Um, Here's the first page of the series first agreement. The blank lines there are intended to fill in all the main deal terms. So it's intended to be like the safe, where all the main deal terms are on the first page, and then the rest is, quote, boilerplate, which I think is important, but the main deal terms, the main economic deal terms are right here. Um, these documents are available for free, just like the safe is available on the Y Combinator website. I created a website called seriesfirst.com. The two documents are available there. The two documents are you need a purchase agreement, and whenever you create preferred stock, you need to have the terms in the certificate of incorporation. So that's why there's two documents. And with the certificate of incorporation, it's a longer document. There is more complexity and there are more pages than the safe, but I'm trying to create something as close to the safe as possible while issuing preferred stock. And I think this gets as close as humanly possible. Um, I think that's good for now, Sam.
Yeah. So thank you. I have a bunch of topics that I have queued up to try to sort through. So I'm gonna go ahead and share. I had prepared a summary slide. This is a lot of information. So let me go ahead and share a summary slide. So conceptually, if you look at the landscape of funding vehicles, okay, you have, let's look at it in terms of criteria, all right, or things to consider. One is how hard is it? How complex is it? Simple at the top, complex down at the bottom. And then there's also, when you do look at the complexity, of course, more complex, the more time it's going to take and the more legal fees you'll probably end up paying. Okay. So another criteria is the certainty of the equity. So on the left side, it could be rather uncertain, and on the right side, it could be more certain. Okay, and what I mean by equity certainty is if you sign a safe or a convertible note or a series first or whatever, how close is that instrument to actually being a stock sale? And do you know clearly how much equity was sold? Once you do know it's a stock sale, okay, if it is a stock sale, then that of course helps you with the qualified small business stock, the QSBS Section 1202. This naturally leaves us with a two by two matrix, okay, where I've done my estimate on where things land. Okay, so in my opinion, a convertible note sits right in the middle of the complexity, and it's fairly uncertain because it's not, well, in terms of how close it is to a stock sale, that moves it far to the left. Okay, it's very certain what it is. It's debt. It's not stock. Okay, but because most people want it to want stock, that's why it's on the far left of this two by two. Okay. So then you have a pre-money safe. And just to be clear, okay, there are actually four different revisions of a safe over time. So the pre-money safe, the original version of safe was released in 2013. And they didn't put a version number on it. Clearly, this was not done by a product manager or an engineer. Okay. Then they said, hey, there were some problems with the pre-money safe, and to correct some of those problems in 2018, Y Combinator released the next version of the safe, which is a post-money safe. And then they started putting a version number on it. So safe version 1.0 is a post-money safe. If it's unversioned, it's probably a pre-money safe, but you don't see very many pre-money safes anymore. Since they released in 2018 the version 1.0, they also released a 1.1 and a 1.2. So there's other more recent variants. If you go to the YC website right now, they'll give you only the latest version. The Series A funding instrument, the preferred stock that Brian had mentioned, that's the big boy. Okay. You're absolutely getting stock and you're absolutely signing up for a lot of complexity. That's the $100,000 in legal fees on both sides. Okay. You have Series Seed, which was the attempt to be a Series A on a diet, a lightweight version of Series A. Okay, and that's less complex, but you still have the same goal of the same certainty. Brian's got his series first here, okay, and then there's another instrument called a series safe preferred, okay. I am in discussions with the attorney Amit Singh, who created this instrument. We will schedule a webinar similar to this in February, hopefully in February, to be able to walk through it, and he can talk us through what he's done there, okay. So these little dots here, I went ahead and put a kind of a line to help people understand, in the spectrum of things, if this was a spectrum, what the spectrum would be. All right. And then I've also annotated with the number of pages in the template. Okay, so you can see the safes, 6 to 7 pages in the upper left, reasonably simple. Brian and Amit's series safe preferred and the series first, 10 to 25 pages. The footnotes down at the bottom clarify, even though Brian's document is 25 pages, it's only 9 pages on the agreement and 16 pages on the certificate of incorporation. The COI is not typically something that you really negotiate or, I mean, you let the attorneys take care of that. Okay. There's not a whole lot of stuff that typically gets changed too often in that unless you structurally make lots of changes to the agreement. which kind of goes against what you're trying to do here. But anyway, hopefully this provides a little bit of perspective. There are a couple of instruments that are starting to appear in the upper right-hand corner, and that's where I would personally prefer to have our the majority of the investments be. All right. So that's kind of where things stand right now. Brian, did you have any thoughts or comments about this?
No, that's an interesting slide. It's a graphic way of doing it. So thanks for preparing that. Yeah.
Yeah, yeah, and keep in mind, I purposely drew that line because if you didn't do this in a two by two and you flattened it into a spectrum, that would be roughly where I would put everything. Okay, convertible notes on the far end of one end of the spectrum, the Series A on the other end of the spectrum. It'd be nice to be somewhere in the middle. Okay, so that's the perspective here. Okay. So, there are a couple of questions here, and I'm maybe I can kind of do a couple of things. I did want to ask you or talk a little bit about a couple of comments. Brian, you mentioned QSBS. Okay,
Yeah.
how often are you seeing in savvy investors today asking for QSBS eligibility?
Well, it's interesting that in the Series Seed preferred stock deal and in the Series A preferred stock deal, there's a representation and warranty that investors often ask the company and the founders to make to promise that the company meets QSBS qualifications. Um, so that gets put in, yes. Um,
Okay.
we could spend a lot of time on QSBS. One important note to highlight is that the law was changed and I
Mhm.
might be rusty on the exact date, either 2016 or 2017 or 2017 or 2018. It was Obama who changed the
Mhm.
law. The IRS Code 1202 was batted around. It provided 100% exclusion from gain, but then it changed and it had always had a sunset on it, so that the gain would expire by the end of the year, or the exclusion from gain would expire by the end of the year. So all investments made during that year would qualify, but then it would go away for the next year. And then there were other years when it was only 50% exclusion. So it was batted around so much before 2017, it wasn't super reliable and it wasn't a big driver in investors choosing investment. But Obama changed the law and made the 100% exclusion from gain up to the cap of 10 million. He made that permanent, and that has stuck since then. And in my opinion, the value of that didn't sink in right away in 2018, 2019, 2020, because if the value of that really sunk in, I think investors would have switched to Series Seed preferred stock a lot more enthusiastically. But this is the same time period at which safes were getting more popular. Um, and it wasn't until the post money version of the safe in 2018 that the creators of the safe put in the terms claiming that it gets IRS code 1202 treatment. So they're acknowledging that it's important. But I think the importance of 1202 is evolving over time. And I have had investors tell me, frankly, that, hey, that's not the main driver. Um, so that said, I think it's important. If I were an investor, I would, especially if you could do something now like a series first where it's so simple and
Right.
you get certainty, I would prefer not to rely on not getting audited by claiming 1202 coverage for the time I held the safe.
Yeah, for me as an investor, I invest through Band of Angels, and in the past 18 months, I've written 9 checks. Okay, um, there was one founder who presented me with a convertible note, and because they were doing a lot of rolling close raises and stuff, he really did not want to change his contract. I was not happy with doing a convertible note, but I thought there was an opportunity to be able to make an investment. So I held my nose and I signed the convertible note, knowing that I would not get QSBS treatment on the day that I signed it. But in order to, because I knew that, I actually cut my investment significantly. I was seriously thinking about writing a much bigger check, the 3 to 4 times the size that I actually wrote, and I cut it significantly. So, okay, because I'm going to lean in harder to the other opportunities that do qualify for QSBS. So that's my take on it. It is something that's very important. It's so important that there is now an industry of service providers who will give you a QSBS attestation. They'll do a little mini audit, okay, if you can call it that. They'll do a review. It's not really an audit. They'll do a review and they'll give you a letter or a document that says, based on our review, we believe that you should qualify in our expert opinion. It's not definitive, but it does help. A lot of investors nowadays, and I always ask for a QSBS attestation. That is such a big deal that these service providers are now charging. Carta charges $2,500 to $4,500 last time I checked. There are other specialty service providers. If your issue is more complex, you can pay as much as $10,000 for a QSBS attestation. So, do sign up. If you signed up for our session here, you're here. We have another webinar next week that gets into QSBS attestations. So in my due diligence class, we have a template that's included. If you buy the class, you get the self attestation, and you can avoid paying $2,000 to $5,000 to a provider if you have if you want to use the self attestation. Okay. So I'll grab the link to that class for next week, or the webinar. It's the webinar for next week. Um, Along these lines here, I would want to ask you this also, Brian. We've talked a good amount about templates. Talk to me about convertible note templates. What do you see? I mean, if somebody does want to use a convertible note, do they start with a template? And if so, where do they get one?
I have my own template. The Angel Capital Association, and which Sam, I think you helped with, or I know that you're deeply involved with. They just created a revised template about a year and a few months ago. So it was about
Mhm.
October or November of 2024. So if you go to the ACA website, you can find the Angel Capital Association template there. Um, Convertible notes, according to Carta, are used for, I think, less than 8% of deals now.
Yeah.
They're very rare. So I haven't done a convertible note in the last year or so.
Hmm.
Um, but when I've done it, so I haven't used the ACA template yet. I think it's good. And they've added protections to investors. So there's important protections there. So if I had an investor that wanted to do a convertible note, I might start with the ACA template because I think it's good. There are other good templates. Mine is good, and it's fairly standard. So yeah.
Yeah. So Brian's right. I wanted to call this out because I don't see a pervasive place to get a convertible note template. You're probably going to get different varieties from lots of different sources. The Angel Capital Association, where I'm a member, I'm on the finance committee of the ACA. The ACA does have a convertible note template that you can use there. All right. But like Brian said, it's less than 10%, somewhere around 8% of the time, a convertible note is actually used. Okay. Um, so let me ask you this. How often do you see safes actually get modified?
I modify safes. I encourage when I represent the company, well, both sides. If I represent investors, I will often slightly modify the safe. When I represent companies, I will modify the safe. The red line is not extensive, but the modification I make is very important. So the conversion nightmare that I talked about
Yeah.
can be mitigated somewhat if you make a few changes to the post-money version. One thing that's really dangerous about the post-money safe is that it sets a post-money, let's say 10 million, and let's say the founder is intending to raise 2 million. So easy math, 2 million out of 10 million is 20%. So if one investor invested 2 million on a 10 million post-money safe, the investor would expect to hold 20% of the company. Um, what happens when you fix the post money is that if you go and you raise more safes or convertible notes after that financing, those additional safes and convertible notes are stuck into what's called the pre-money. So the way you calculate post money is you take pre-money. So pre-money valuation is 8 million, new money is 2 million, post money is 10 million. And founders hold the pre-money. Uh, so if investors get 20% because of the new money, and the cap is 10 million, founders own the remaining 80%. But if the company raises more safes and convertible notes, those get stuck into the pre-money realm, or in the calculation of the conversion, it gets stuck in the denominator. The bigger the denominator grows, the more the founders get diluted. Because again, simple math, if the cap is always 10 million and you start raising more than 2 million, you raise 3 million, 4 million, 5 million, that means that the pre-money just shrinks. So a change that I make when I represent companies is that I will put a fence around that calculation. So there's a section in the SAFE that is a defined term called company capitalization, and
Mhm.
I change those terms and I put a fence
Yeah.
on what's included in that calculation.
Yeah, that's I've seen many attorneys do that out from the investor side. I'm not a fan. Okay, from a founder side, I am a fan. Okay. So the change that Brian's talking about really, I think, protects the founders. One of the things to be aware of is savvy investors will probably push back some. Most
Yes.
investors probably don't pay attention to this level of detail. So I think Brian's advice is a good one. One of the things that also to be aware of is that if you present a modified safe to a seasoned investor who's actually paying attention, they'll probably hesitate. They'll probably slow the deal down. Okay,
Yeah.
because they're
Yeah.
probably going to look at it and say, "What changed? Show me the red lines." That's exactly what happened. I just signed a safe 3 days ago. Okay. All right. And that's exactly what happened. The founders changed it. I'm like, okay, I want to know what changed, and I have to analyze it and stuff before I commit to it. So just be aware that it's a trade-off, and the more you make changes, even though it may be beneficial to you, it can slow down the velocity. And in some cases, if the investor has more leverage, they might say, I don't like that change. Okay. So then you get into a legal negotiating challenge. Okay. All right. So safes do get modified, but just keep in mind the
Investors
downstream impact.
also, yeah, investors also like to slightly modify it because it
Yeah.
it it triggers conversion on a equity financing, but it doesn't define what equity financing will trigger that. So investors often like to put that it has to be at least a 1 million financing or something
Hmm.
like that. So
Yep.
that's one minor change investors often like to see.
Yeah. Yeah. So the bottom line here is that the safes are not a panacea. I think I get concerned when founders blindly use a safe because it's popular. Okay. Um, and I think what's happening is that many founders are not paying attention and they don't know how difficult it's going to be. The We had one founder who had one startup that signed 27 safes or something like that. And when it came time to actually convert them and raise the price round, they spent a ton more time, probably 30, 40, $50,000 more in legal fees because the stack of safes was so complex that it just took a lot longer to kind of sort through it and negotiate and get everybody to sign off on that. Okay.
I saw one question, Sam, about high resolution fundraising.
Hmm.
It might be worthwhile to chat about that
Yeah.
quickly. It's a really important topic. So Paul Graham, as far as I'm aware, is the first. There's a blog post he wrote, and I have the link to it long ago where he described that. And he that's a attractive feature about the safe because
Hmm.
it's one agreement with each investor. So
Hmm.
founders could issue a safe to Sam as an investor today with a 10 million valuation cap. Then, because he came in early, he gets a lower val cap, and then investor comes in a month later or 2 months, whatever, and because it's later, he gets a higher valuation cap. Or you could change discount rate. You can change any term you want in the safe agreement with each investor. And also, a typical Series A deal or a Series C deal envisions that you'll have one closing where all investors come in as a group in one closing. It does allow for subsequent closings, so you can do multiple closings, But the idea is you do as few closings as possible. You're really gathering all the investors, all the same terms, and you're closing in one deal. And then you might do one more subsequent closing, maybe a third. Um, but so that's very different. Series A, Series Seed, very different. You're having discrete closings. Everybody's getting the same terms. Even if you do a subsequent closing, everybody's getting the same terms. Safe allows you to the Wild West. You can do whatever you want with each investor. So that's a benefit in a sense, but it also creates complete hell because the more of these you stack up, it's just a nightmare. So yes, you can do it with safes. So the question was, can you do it with series first? The series first is designed, you don't need to do one closing. So you can do each investor with, so once you file the certificate of incorporation setting the terms of the series first, now you can sell series first whenever an investor is ready. So that's half the part of the high resolution fundraising, meaning that you can purchase agreements with investors whenever, one investor now, another investor a month later. The
Hmm.
more important question though is, do they get the same terms? The way I've built it so far is yes, they get the same terms, so it doesn't allow for varying the important one, the valuation. There is a way to modify it to allow for full high resolution fundraising, and that would be change the definition of the original issue price in the certificate of incorporation and refer to the price as set forth in a purchase agreement. I didn't make that in my template, and I am considering maybe a version 2.0
Hmm.
including that. And then just to answer a separate topic, one other question. Now I'm forgetting the question. Shoot, sorry. I was going to ask. Um, but
Yeah,
Sam,
no
you
worries.
might have.
No worries.
One other question was, what if you have a bunch of safes and you want to do a series first and you want to clean up the cap table, get rid of the safes and convert them all into series first? Can you do that? Yes, but you need to modify the series first slightly because you'll probably want to do what's called shadow preferred, and you'll probably want to put the existing safes that convert into preferred stock, given their, whatever their discounts are or their valuation caps or whatever, they're probably going to have a different. They're gonna go into shadow preferred, and I've already created a template to allow that. I just didn't make. I wanted to keep things simple when I launched the series first. I wanted to be very clean, but I do have a template to allow for converting existing safes into series first.
Yeah, yeah. So there's a question about shadow preferred, and maybe I could just offer my perspective, and Brian, you can correct me if I misspoke. Um, the shadow preferred is the type of stock that if you sign a safe, when the investor actually converts the safe into preferred, they get a a series of preferred stock that looks close to the Series A stock. There's maybe some slight differences in terms of a few privileges, and that's would be referred to as shadow preferred. There's definitely some differences in terms of the economics. Okay. Brian, do you have anything to add about shadow preferred?
Well, that's another complex topic that could take a lot more discussion. So I think it's good for
Okay.
now.
High level. All right.
Yes.
Okay. Question, what are the pros and cons of high resolution fundraise? And to summarize and reiterate, high resolution fundraise is just basically instead of doing a big fat fundraise and trying to get everybody to synchronize when they're going to actually close the round, you just do a lot of smaller fundraises as you go. When you have an investor who's willing to do it, you might do a 25,000, a 50,000, 100,000 round tranche, or sign a 25, 50, or $100,000 investment agreement, and then when they're ready to go, you just sign it and you move on. And then a month later, you might have another investor who's ready to go, and you sign it and you move on. So that's the high resolution cadence. In terms of the advantages, disadvantages, well, one big advantage for founders is, the moment someone's ready to fund, you sign the deal and money shows up in the bank. Okay. You don't have to wait for some big massive event, the once a year event or once every 18-month event, whatever, to be able to get the funds. So that's one significant benefit. maybe one significant cost is that the terms may vary between each contract that you sign, which then complicates the overall conversion of these safes. If you do it on a safe, it would complicate the conversion when you do have a Series A to convert it. Any other thoughts
Yeah,
about advantages,
yeah.
pros and cons?
Paul Graham, when he talked in that blog post, he praised the ability of founders to reward early investors with better terms and less good terms for those who came later. And that's the advantage of high resolution fundraising, in addition to just getting in money in as each investor is ready. Um, so yes, it's an advantage, but it also creates cap table hell. So all of that cap
Yeah,
table nightmare that I quoted from, oh, now I'm blanking, but the blog post from Fred Wilson,
yeah, yeah.
the nightmare that everything comes crashing down. The more different terms you have, the more different valuation caps you have,
Mhm, mhm.
and the cost increases for attorneys and accountants, everybody to just model this stuff out. Just takes more time. And I know Carter will track a lot of it, but it does just wildly increase the complexity
Mhm.
and the surprise at what happens when everything gets resolved and finally converted into Series A. Oh,
Yeah,
and I should add, this is a different topic. I didn't include this in my bullet points, and maybe I should for future presentations. One of the risks of the safe is that, let's say you negotiate a 10 million valuation cap, and then the company later raises its Series A, and it's maybe a 50 million valuation at that time. So the investor who converts at a 10 million valuation cap gets a gigantic discount. And
yeah,
so they're converting and they're essentially using the money they have already paid into the company, but that money is being used to buy Series A preferred stock at a gigantic discount that's calculated based on that 10 million valuation cap. And so new investors coming in are paying a price per share in Series A that's calculated on a $50 million valuation. And they're seeing all these safe investors convert at 10 million valuation cap, a much lower purchase price that they get. So I've seen this in my practice, whether I'm representing companies or investors, where investors ask safe holders or convertible note holders to waive certain rights or to change certain rights and to convert at different terms. So that's another risk of convertible notes and safes is that they can be all renegotiated. And the
yeah,
safe and note holders, investors are facing, they can either dig their heels in and say no and hold up the Series A and compromise the company, or usually what happens is they say yes because they want the company to get the financing and move forward.
yeah. I think what Brian's basically saying is that just because you have a deal signed in the past doesn't mean it's ironclad and etched in stone forever. A new incoming heavyweight investor could bully um, uh, you know, previous investors and or previous or whatever contracts and ask for you to change the contract. That's still in the realm of possibility.
But
Okay.
it's much harder if you issue preferred stock, if you issue Series First or Series
Mhm.
Seed or Series A, highly unlikely. In fact, I think it's not possible to change the price you paid. You can't change that. So you can't change the valuation cap. Once you buy Series First, it's done. You've paid the money, you've gotten the stock. So
Yep. Okay. Lots of detailed considerations. I mean, we can go on for a very long time. As you can tell, Brian has a lot of knowledge, a lot of low-level detail. It's a little difficult to communicate all that knowledge in a summarized way because there's so much nuance. Okay. And that's one of the reasons why it's important, I think, to make sure you have qualified counsel to help you, great advisors to be able to help you to be able to make some of these decisions and navigate the journey. Don't just follow the crowd because it's not one size fits all. Every situation is different. Make sure that you do what you do to maximize your fit for your specific situation. I've got a slide here that summarizes our founder training content. A lot of the content that you've seen us produce, we try to take some of these concepts, communicate the level of detail that you need to make an informed decision while still making it as clear as possible. Okay, so we would greatly appreciate it if you're interested. It helps us to be able to continue to fund these types of events and these types of this type of research. That one slide that I shared here, this one slide, that took like 2.5, 3 hours just to put together. Probably more than that. But you know, when we do a 50 slide presentation, you can kind of figure out that there's a lot of stuff that a lot of time and energy invested. So we appreciate your support. Okay. Brian, any things to wrap up because we are over time.
Mm. We could talk a lot more. This is the subject we, like you said, we could spend hours. And it's a fun subject. Of all the legal work I do, I think I enjoy most doing early stage financing deals. So I love to chat. And I love to do these deals and love to chat with people about them. So are we gonna hang out for more Q&A or are we gonna turn it off?
Um, I was thinking about wrapping it up. Let me see if I've missed any big questions. Brian, did you see any questions that went through that you really want to address?
Some of the big ones I glanced, there's a lot. So I appreciate all the comments in the chat, but I haven't been able to pay attention to them all. So I apologize for that.
Okay.
Yeah.
Brian, do you want to pop into the chat a way for people to get in touch with you or how to maybe book a consultation?
Oh yeah. Here. Yeah, so you can find me on the Ramon website. It's ramonlaw.com. Um, and my email address um,
Let me see.
is is
Right there.
brian.dirkmaat@ramonlaw.com.
Okay. So that's Brian's contact information. Um, uh,
Oh, there you go. You just showed it. Thank you.
yeah. Yeah. Okay. Thanks
LinkedIn
everybody
is a
for. Oh,
LinkedIn is also a good way to connect. I've posted a lot in the last couple of months about the series first, so if you look at my posts, you can see more information.
got it. Yeah. There's a lot of information here, and I hope it's at least sensitize folks to the fact that when the time comes for you to be able to do the fundraise, pay attention to these details. It can make a very big difference. The QSBS can save you as a founder as well a lot of taxes in the future. In addition, the general takeaway is make sure you know that you know the detail and don't just blindly follow the process that everybody else does because I think there's a lot of people who are signing safes right now don't realize the nuance and the dangers and the where the traps come into play. Okay. So thanks for your time. Appreciate it. Do pay attention to your email. We do have we will announce the other webinars. The self-attestation on the QSBS. I already put the link into the chat. We would love to have you sign up for that as well. And thank you. Best of luck building your own fundable startup. Okay.
Thank you.
If this was helpful, please like this video and subscribe to our channel. You can also check out our other videos for more startup content.